Hello everyone. So now let's talk about transfer pricing. And transfer pricing is something that's very common among companies that have different divisions that complement each other, or in other words, they provide products or services to each other. So when divisions transfer products or render services to each other, a transfer price is used to charge for the products or services. Because if you think about it, a division still wants to make profit even though they are providing the product or service to the other division. So the product or the service could have been outsourced, but they're going to bring it from another division in the same company. The company, the other division, doesn't want to feel like they're losing because they're serving a company or another division within the company. So there are three common approaches to setting transfer prices, which include market price approach, negotiated price approach, and the cost price approach. And we'll talk about each one of these. So transfer prices may be used for cost, profit, or investment centers. The objective of setting a transfer price is to motivate managers to behave in a manner that it will increase the overall company income. Transfer prices can be set as low as the variable cost per unit or as high as the market price. And if they're using the market price, usually there would be no motive to go to the division within the company unless it's just stability and consistency of the supplies. So it could be as high as market price and are often negotiated at some point in between. So for the sake of understanding transfer pricing, we are going to apply or use a company called Wilson Company, a packaged snack food company with no support departments. And this is the example that we're going to be applying for the rest of this chapter. So, as we mentioned before, commonly used transfer prices can vary from the lowest, which is variable cost per unit. I don't think any division is willing to set a price below the variable cost, that's the minimum. And the highest would be market price, because if it's more than the market price, the other division would outsource it. There would no need to buy it from the internal division. And it could be a negotiated price between the variable cost and the market price. So it could be something like the full cost per unit. So let's go over the market price approach. So using the market price approach, the transfer price is the price at which the product or service transferred could be sold to outside buyers. If an outside market exists for the product or service transferred, the current market price may be a proper transfer price. So if the division has an option to sell it outside in an outside market, so why would I sell it for a lower price at the other division within the company? So that's usually one of the dilemmas. So assume material used by Wilson in producing snack food in the Western division are currently purchased from an outside supplier at $20 per unit. The same material are produced by the Eastern division, which is operating at the full capacity of 50,000 units. Remember, it's full capacity. They cannot produce any more. And it can sell all its products to either the Western division or to outside buyers. A transfer price of $20 per unit, which is the market price, has no effect on the Eastern division income or total company income, and likewise the Western division will pay $20 per unit for material, which is the market price. So in this situation, the use of the market price as the transfer price is proper because, again, full capacity and they already have a market for them. So in this case, if they are going to sell it to the other division, which is the Eastern division, in this case, why would I sell it for a lower price? So here we have an income statement, but here we are assuming no transfers between divisions. So we have the Eastern division, we have the Western division. They have 50,000 units, that's their capacity at $20 per unit. And the Western division is the one that would use or can use any of these units produced by the Eastern division, but in this case, they're going to outsource it. So their expenses for each division, we have for the Eastern division, it's 50,000 units at $10 per unit. And for the Western division, it's 20,000 units at $30 per unit. But keep in mind the $30 per unit, $20 is they say here of the $30 per unit represent material cost, and the remaining $10 per unit represents other variable conversion expenses. So the focus is only on 20 out of the 30. So you can see here the operating income for the Eastern Division is 200,000, and for the Western Division is 100,000, making the total company income 300,000. Now let's go over negotiated price approach. The negotiated price approach allows the manager to agree or negotiate among themselves on a transfer price. The only constraint is that the transfer price has to be less than the market price, but it also has to be greater than the supplying division's variable cost per unit. So the range, the transfer price here, has a range. The minimum is the variable cost per unit and the maximum is the market price. So assume that instead of a capacity of 50,000 units, the Eastern Division capacity is actually 70,000 units. And it can continue to sell only 50,000 units to outside buyers. So in other words, they only have a market outside for 50,000 units, but they have a capacity for 70,000. So the extra 20,000 can be actually produced for the Western Division. So transfer price less than 20 would encourage the manager of the Western Division to purchase from the Eastern Division, because the Western Division is currently purchasing its material from outside suppliers at a cost of $20 per unit. So at the same time, a transfer price above the Eastern Division variable cost per unit of $10 would encourage the manager of the Eastern Division to supply material to Western Division. So in other words, this is a situation where it's going to be a win-win between the Eastern and the Western Division. The Western Division would be winning if they bought it at less than $20, and the Eastern Division would still be winning as long as they're selling it over $10. So here we have an example of an income statement based on the negotiated transfer price, but here we're assuming that the transfer price was set at $15. So you see that for the Eastern Division, they still sell the 50,000 units at $20 to the outside customers, but 20,000 units at $50, that's for the inside or the Western Division. So these are the products that would be sold to the Western Division for a total of 300,000. So now their total sales went up to 1.3 million. Let me compare that to what we had in the previous example with no transfers. It was only $1 million. So now they're able to have 1.3 million. How about the Western Division? Again, their sales is 20,000 multiplied by 40, and that's 800. It's exactly the same as what we had before, 800,000. So the Western Division was actually able to save on their expenses. And that's the thing that we're going to see here. So expenses for the Eastern Division, the variable cost is $10. So 70,000 units for $10, that would be 700,000. And for the Western Division now it's 20,000 units at 25 instead of 30, and that would bring it down to $500,000. It was actually 30, yeah, at 30. So you can see here that the Western Division, instead of having 600,000, now their cost went down to 500. But for the Eastern Division, their cost increased a little bit because they had additional 20,000 units. Instead of having 50, now they have 70. So the total expenses, or the total variable expenses, is $700,000 compared to $500,000. But the most important thing, the bottom line numbers. So operating income now for the Eastern Division is 300,000 compared to 200,000, and for the Western Division now it's 200,000 compared to 100,000. So the total company, instead of making 300,000, now they're making 500,000. So you can see that the transfer by selecting, or the transfer pricing by selecting a price that's between the variable cost and the market price, which in this case was $15, led to the incentive for the Eastern Division manager and the Western Division manager to complement or complete this transaction, and each one of these divisions were able to increase their operating income by $100,000. So just to repeat that, the increase of 100,000 in the Eastern Division income is as follows. It's the transfer price minus the variable cost multiplied by the units transferred. So the transfer price was 15 minus the variable cost of 10 multiplied by 20,000 units, that's 100,000. The Western Division material cost decreased by $5 per unit. It went down from 20 to 15 for a total of 100,000. So because we have 20,000 units that they bought at $5 each, then the Western Division operating income increased by 100,000, or increased by 100,000 to reach 200,000. So the increase of 100,000 in the Western Division income is calculated as follows. We have the market price minus the transfer price multiplied by the units transferred. So 20 minus 15 multiplied by 20,000, that's the 100,000. So you see here, both divisions made $100,000 in profit. So as I did, I compared Exhibit 10 and 11, and that shows us that the operating income increased by 200,000. You see here, the no units transferred, the Wilson Company had $300,000 operating income, but when they had the 20,000 units transferred at $15 per unit, both divisions now they had an extra 100,000, which increased the company's profitability by 200,000, which is now 500,000. So you see the increase is about $200,000. So any negotiated price between $10 and $20 would be acceptable. Remember, $10 is the variable cost and $20 is the market price. Is going to be acceptable. And believe it or not, any price between these, or any transfer price between these two values would lead to $200,000. So as long as they reach a transfer price that's between these two values, the company is going, the total for the company is going to be increased by 200,000. I mean, the operating income for the company is going to increase by 200,000. The only difference is going to be the allocation between the Eastern and the Western Division. So any transfer price within this range will increase the overall operating income for Wilson by 200,000. But increases in the Eastern and Western Division operating income will vary depending on the transfer price. So to understand that more, let's assume a transfer price of $16 would increase the Eastern Division operating income by 120. And as you can see here, the $16 minus the 10 multiplied by 20,000, that's 120. But for the Western Division, it's only going to increase by 80,000. So 20 minus 16 multiplied by 20, that's $80,000. Remember, the 20, that's the market price. 16 is the transfer price. That's the amount that they were able to save. So they increased their profit by 80,000. So a negotiated price gives each division manager incentives to negotiate the transfer. In this case, I think a $15 would be a fair price because it would allow both divisions to make an exactly the same amount of profit. So let's see the cost price approach. So under the cost price approach, cost is used to set transfer prices. So a variety of costs may be used in this approach, including total product cost per unit and variable product cost per unit. If total product cost per unit is used, direct material, direct labor, and factory overhead are included in the transfer price. If variable product cost per unit is used, the fixed factory overhead cost is excluded from the transfer price. So actual cost or standard cost may be used in applying the cost price approach. Remember, the standard cost is what we call it, the budgeted cost. So actual cost or the standard cost may be used in applying the cost price approach. However, most companies use standard cost. The cost price approach is most often used when the responsibility centers are organized as cost centers. When the responsibility centers are organized as profit or investment centers, the cost price approach is normally not used. It's not really, it doesn't create this kind of incentive. All right, so let's do some knowledge check here. Which of the following is not one of the common approaches to setting transfer prices? We talked about the market price approach. we talked about the cost price approach, we talked about the negotiated price approach. But I don't think we talked about something called the variable cost price approach. Why is that? Because it doesn't exist. So variable cost price approach is not one of the common approaches to setting transfer prices. Remember, the variable price or the variable cost is the minimum for negotiation, but we don't have a cost approach called variable cost price approach. So the three common approaches to setting transfer price include the market price approach, negotiated price approach, and the cost price approach. Alright, so last part in this chapter we just want to do some analysis for decision making, and we're going to be talking about something I'm assuming that many of us heard about, which is franchise operations. So what is a franchise? A franchise is the right or license granted to an individual or group to market a company's goods or services. I think one of the well-known franchises is McDonald's, for example, or Subway. And by the way, these are very well known in the fast food business, and I think these are the biggest values franchises. So the franchisor is the entity that provides the franchise, which is the McDonald's company, while the franchisee is the entity that pays for the franchise, which is the individual or the company that's going to acquire the franchise. The franchise fee is often expressed as a percentage of revenues earned by the franchisee. The franchisee invests in the property and equipment to deliver the franchise products or services. The franchisor often provides support in startup, advertising, management development, business systems, and also supplier relationships. The main benefit to the franchisor is an ability to expand the brand without investing significantly in property and equipment. So what is the benefit for the franchisee? Is that they're using a well-known name, and that can help them be profitable. So from the franchisor's perspective, the return on investment should be increased by the low investment. So therefore, the DuPont formula should show a healthy profit margin combined with a high investment turnover. So I think this is a good application for the return on investment and the DuPont formula. So let's use an example here for the Hilton Worldwide Holding Company. They have a ticker HLT. They has both company-operated and franchised hotel operations. So the name Hilton can be used by some of the hotels that are owned by the Hilton company, and they also have the franchise. So segment disclosures with some assumptions regarding owned and franchise operations are as follows. So here we have the revenues for the company-operated branches and the franchised hotels, and then the operating expenses. Of course, for the franchise, they don't have any operating expenses, it's zero. And here are the general and administrative expenses and also the invested assets. So total general administrative expenses is 440. I'm assuming this is $1 million. Assume that 90% of this number expenses support franchised operations. So to calculate the return on investment using the DuPont formula it's just to refresh your memory, the return on investment is the profit margin multiplied by investment turnover. And instead of sales here, we're going to be using revenue, which is the same thing. I like to call it sales revenue or simply revenue. So for the company-operated hotels, the return on investment, you see here, the profit margin is 8.7% and the investment turnover is 0.12. So the return on investment is only 1%. For the franchise hotels, you can see it's way more profitable for Hilton. The profit margin is 82.3% and the investment turnover is 1.74. So that would give us a return on investment of 143%, which I think in this case it shows the reason that Hilton might be more interested in franchising their service or providing this franchise to other hotels who are interested, because it's much more profitable for them. So by that, I conclude chapter 24. I wish you all the best. I hope this was helpful. Please study hard, and I'll see you next week.